One competitor.
One competitor can knock a kingdom down.
Yeah. We're Compound Everything, and we talk money, markets, and investing. And today we're talking about the 1994 Berkshire Hathaway annual meeting.
Afternoon session.
Yeah.
So what were our takeaway points? There's a lot of good things they talked about. Actually, I thought the afternoon session was kind of more jam-packed with information than the morning session.
Yes.
And it was only an hour.
Yes.
So if you have a short amount of time in your hands and you want to get some good information, check out the afternoon session.
Yeah, definitely better than watching us.
Yeah, I thought one of the more, call it fascinating things about going through the Berkshire annual meetings was just hearing them talk about, we talked a little bit about this last time, but was the businesses they've kind of owned and that have changed dramatically over time. So one of the first topics they talked about in the afternoon session was World Book.
Yeah.
Now, maybe some of our viewers wouldn't know what World Book was, but it was an encyclopedia. Right, so they had an encyclopedia business called World Book, and that competed with Encyclopedia Britannica. But anyway, they had an encyclopedia business, and at the time of the shareholder meeting, they had noted that I think the sales from the World Book were dropping off.
Yeah.
And so they were kind of trying to figure out why. And keep in mind, this is 1994. This is kind of at the cusp of the internet. And one of the things that Buffett had mentioned was kind of digital media maybe eroding into their business. And I can't remember, he said a couple other things potentially, but I just thought it was neat that you can see that over time, the businesses they had actually but lost their competitive advantage.
Right, some of the businesses.
Some of them, yeah.
Only a few of them.
Only a few of them, so World Book being one of them.
Yeah, and what was interesting about World Book was what they didn't quite see coming was how open source would work.
Yeah.
Right, so he mentions... because
Wikipedia was not a thing.
It was nothing. So he does mention in 1994 that digital print and whatnot is, in fact... Probably. He said there were many issues with World Book, but that would be one.
Yeah.
And then he went on to say how he trusts the manager of World Book and whatnot. But I think what they missed on World Book wasn't so much the digital aspect or the internet aspect, because if the internet had to be paid for, or, websites, World Book would probably still be a thing.
Right.
I think what caught them completely by surprise, of course, this is looking back, we have the advantage, was open source.
Yeah.
Open source just screwed over all the encyclopedia businesses.
I guess the question is, why would someone spend a bunch of time to put a bunch of information on a website for anyone to access for free?
So open source really, I think, caught
that business by surprise.
And another fascinating point from that is that Buffett always says he doesn't like to invest in tech because tech has to cannibalize itself in order to keep growing. That is what tech companies do. But a lot of times, businesses that aren't considered tech businesses are also cannibalized by tech. So,
that was a pretty boring routine business, is the development of encyclopedias. It's just passing along information. So in this case, like in the case of World Book, technology was extremely deflationary to the point where it almost erased or wiped out their business.
Well, when we bought our house, there was an entire
stack of encyclopedias
in the basement. They didn't take with them. Yeah. They left the dress, and we put them right in the garbage.
Yeah, they were worth nothing.
Yeah,
no one wanted them.
The other thing with World Book is they were expensive. Encyclopedias were pricey. Yeah. And in order for them to be current, you had to update them every 3 to 5 years. Yeah. Right? And even then.
They were probably out of date by the time you got them.
Right? So now everything's just changing. I mean, Wikipedia, someone dies, famous, and that information is changed within seconds.
Yeah, I was going to say minutes, but you're probably right. It's probably within seconds.
Yeah.
So the point being, I guess, the takeaway point from that is any business that you own as a individual investor, keep your pulse on the business. And that's where they talk about central tenets being when they can understand. The business has to be one they can understand. Yeah. So in a sense, you have to be able to understand as an investor, when is my business being threatened and by what? So what could take it off its horse? What could erode its moat? Because that's constantly happening in capitalism. Yeah. There's always enemies trying to storm the castle, so to speak.
One competitor.
One competitor can knock a kingdom down.
Yeah. One shareholder asked about the highs and the lows of Berkshire, and I guess why in this particular year there were so many swings between their share price.
Yep.
And Buffett went on to say that that was just market participants doing their thing,
right.
And they actually don't like that.
I think he said his quote was, the stock price outperformed the business, basically.
That was pretty much what he said.
Yeah.
And he said generally Burke doesn't do that because he said
its shareholders tend to be rational and
long-term
holders.
Right. So that's not common, but he said sometimes it does, market traders and whatnot jump in and it does bring price. But what was really compelling in that question was the story he talked about, the stop loss.
Yes, I was going to just say
that. So go ahead.
No, but he caught wind that someone had placed stop losses on Berkshire at 15,500.
Yeah, and I think he said it was about a $4 million position.
Yeah, something like that.
That's what he said in 1994.
Yeah.
And
so considerable.
And he was like, why at 15,500?
Yeah.
I mean, that was where the stop loss
was. And the Berkshire was trading recently at around 16,000.
Yeah. And then it hit.
Right.
Right, and the
it's order executed.
Right, and the guy lost all his shares and he sold at 15,500. And his exact quote was, I guess for people in the market, the lower it goes, the more they want to sell.
Right, and he couldn't understand that.
And I chuckled at that because, well, we all know what Berkshire is trading at today.
Yeah, exactly, something like 500,000.
Right, and he's like, I don't understand why people would buy it at 16,000 or 16,500 and then sell it at 15,500.
Right.
But I think what caught my attention there is that a lot of people do not invest like Charlie and Warren.
Right. And that's why they can't understand it. And it makes you really think about it. Because he said, too, like, as a house owner, you wouldn't necessarily call your real estate agent and say, well, if someone's making offers on a house, if it goes down to $90,000, I really want you to sell, even though the current market price is $100,000.
Yeah.
Like, that wouldn't make any sense to him.
No sense. So,
Despite the fact that none of the business characteristics had changed. Nothing had changed. In fact, over time, Berkshire was getting better and better and better. So another point that a shareholder brought up is Warren and Charlie are always talking about how they like when the stock market goes down, right? They like that because it results in businesses being put for sale at attractive prices. And that makes total sense. But the other thing they said in the meeting was that if they have cash on hand, they've essentially failed the shareholders. They failed to do their job well, in essence, because they have not found anywhere to put capital. And so the shareholder asked, he's like, well, if you are looking at the market going down and you have done a successful job of deploying all the capital, where's this cash coming from? And essentially what they said was, well, it's coming from our other businesses, they're generating returns and this, that, and the other
I think he said our other businesses generate so much cash.
Yeah.
We don't need to keep cash on hand
Yes.
for a market event because our other businesses are just cash machines.
Yeah. And on that point, he said that they won't actually, he uses the word husband cash. In order to potentially predict a downturn in the market. Right. If they see an opportunity, they take it. Right. If they see a compelling opportunity, it doesn't matter what the macro trend looks like, they're going to jump on it.
Exactly.
And that's worked out well for them.
Yeah.
Over time.
One question that was asked, a shareholder asked about puts.
Yes.
Writing puts. And that resonated with me on a personal level because I do that.
Yes, I've done it too.
Right. Many times. And his answer was surprising because he said he did do it for Coke.
Yep.
And they actually made a lot of money doing it. But he said if they like the business, they're not going to write a put. They're just going to buy the and you said that's happened to you where you've sold a put and then it never hit.
Right.
And you never got your shares and the shares went back up.
The shares went back up. Yeah, exactly. Yeah. So what he said is he didn't think it was a good, efficient use of his time to be looking at writing put. Yeah. Well, and the fact that he said it wasn't a very good use of his time to do that, and he said rather than writing puts, is probably a better use of his time just to buy the shares outright. Yeah. Yeah. So
if you like the stock,
just buy it.
Shares at the appropriate price.
Right.
Yeah. Don't let them get away from you.
So the media follows Warren and Charlie and Berkshire Hathaway closely, to say the least. Okay. So one of the questions that was asked at the meeting was that the shareholder stood up and said, I've read reports that Berkshire was actively involved in buying several stocks. I think one of the ones was Philip Morris, but I'm not positive on that. And he said that then I looked over the annual report and that wasn't in there. And he said, what's going on?
He said, why haven't you
disclosed this? And in essence, what Warren said was that probably about 50% of the media articles or more, well over 50% of the trades that are recorded in the media that Berkshire is reportedly have done are erroneous.
Right.
So for whatever reason, the press thinks they've got something and reports that Berkshire is buying XYZ stock, and it hasn't actually done it.
Yeah. And he said that there were some big papers that did that.
It was Wall Street Journal,
USA Today.
Yep.
Yeah, and he said well over 50%. And I also like that he said we don't correct them.
Right.
We don't correct them because
it could be to our advantage.
Right. He said if we correct everything that they did wrong, then people would know
what we were buying.
If they got it right. So they just choose. He said it actually works out to their advantage that all of these false reports or all of these false news articles come out about Berkshire, and they just kind of let it.
Yeah. Well, on that same vein, it makes me wonder if that same thing still happens.
Yeah, like does it? Yeah,
I think it might. And he said the only thing that you should really trust is A, their annual report, and then B, any filings they make with the SEC. Yeah. There's speculation that goes on all over the place.
So you really got to do your diligence.
You really got to do your due diligence, and probably best not to buy on a headline or a whim.
Look into it.
So that's gone on for the past 20.
That was 1994.
Yeah, 32 years now.
Yeah,
so
exactly.
It's nothing new.
No. One person asked them, how much should you allocate to a position you love?
That was a good question.
Very good
So question. They said, how much are you willing to go into a position? What's your maximum position you're willing to...
Proper allocation.
Yeah, proper allocation. And what was his answer?
That we never buy enough of what we want.
Right.
He said we are always disappointed because we always want more.
Yeah.
And I think he said at one point they put 40% of their portfolio into one position.
That was in the Buffett partnership.
Yeah.
Yeah, when he was running the Buffett partnership. And then he had said, Charlie, I think you've done more than that. Yeah. His answer was, or something like that.
That was it, so again, and we came across this same idea of concentration this year at the 2022 Berkshire annual meeting, where people were wanting answers. Yep. The guy beside us, he wanted...
There's a Columbia University business student who said to us, he's like, well, Mr. Buffett's going to have to explain why he's so heavily weighted in Apple. Right,
and then, of course, Buffett comes on and says, oh, we bought more.
They had bought more.
Right, so he is a believer in concentration in a company that has a competitive, durable advantage.
And one which they understand.
And And I think the best part of that question, and I don't know if it was Buffett or Munger, he talked about that man who was willed his father's estate.
Oh yeah, that was great.
Right, and this guy, so he was talking to a bank. I guess it was a trustee. And the bank trust. So this man was willed his father's estate. This man's
which consisted of two stocks, a significant holding.
And then, he was willed his father's estate, and then he had a brokerage account. And the brokerage account consisted of two stocks. One was Berk, and I can't remember.
And the other one they didn't disclose.
They didn't disclose. Okay, that's why I can't remember it. So. And then the trustee told the son, you should probably diversify your holdings. Two stocks is not enough. The bank trustee. And then the son said, well, I could listen to, or my father could have listened to you and diversified, and he could have been a bank trustee. Or he could have done what he had done and had this large estate that you're managing.
So which do you think is better?
Right. So he didn't diversify.
No.
Yeah, and I think Charlie and Warren really liked that story.
Oh, for sure. So
that was a really cute and humorous story.
Yeah.
But it also shows, again, they are real believers in concentration.
Right. Concentration builds wealth. Diversification keeps it. And what they said was diversification for those who maybe don't want to...
do the
homework or don't understand business necessarily, it's probably best they diversify and diversify heavily, I think is what Warren said.
Well, he always is. Buffett is always telling people, most people should put their money in indexes. And the reason he says that isn't because he believes that the indexes are wealth builders.
Right.
What he thinks...
They're wealth preservers.
So people are not going to lose their hard-earned money, and they will probably get a little bit of a return. But his main reason for that is because he knows most people don't want to do the homework and the work, and two, most people can't handle the emotional side.
For sure. Well, and he made another good point too. He said a lot of people make investments that are not diversified anyways.
Right.
Just in general. So
right.
he used the example
that was a really good point.
So he used the example of someone going and buying a gas station,
mm-hmm.
or someone going and buying a farm
mm-hmm.
or a dry cleaner.
Yeah.
And so you may, as a investor or a businessman, go and place a significant amount of your assets into one specific sector, call it.
And no one would call you crazy.
Right, no one would call you crazy for opening up a gas station or a restaurant.
Took out a loan, or took all our capital that we have.
Yep.
And most people would be like, "Wow, that was a great decision.
Yeah.
Good for you.
Good
You're
for
being
you.
an entrepreneur."
Yeah,
no
that's
one
great.
Would, yeah.
Yeah, but at the same time, what is the statistical probability of a small business going bankrupt? I don't think those
a lot of small mom and pop shops.
But for people who would go out on their own and start a business, the failure rate is huge.
Yeah, but no one really looks down on that.
No, not at all.
Right? They say, "Oh, it was like bad luck," or like,
mm-hmm.
"You know what? Good for you." Even if it fails, people often be like, "You know what? Good for you for trying. You went out there and you tried.
Right.
You know, what a great experience."
Right.
Yeah.
The question then becomes, what is the failure rate of a small business that's mm-hmm. created by you or I mm-hmm. versus a large dominant business in their industry right. that you know really well? Like, is there really more risk in buying and concentrating in a business like that just because it's publicly traded and you don't have control over it mm-hmm. versus one that you kind of start up yourself and just try and grind at?
Well, I think a good example for us would be like if we wanted to go and start a hardware store.
Sure.
Right?
Yeah.
Would it be better for us to take all of our wealth, our mm-hmm. combined wealth, and start a hardware store in our city?
Compound everything hardware.
Compound everything hardware, right? We
right.
find a good location,
yeah.
we start it up. Or, would it be better for us to take all of our combined wealth mm-hmm. and put it into Home Depot?
Right. Or Lowe's.
Or Lowe's.
Or both.
Or both. Right.
Right.
Two positions in our
positions, yeah.
Right, and people be like, you'd be crazy to put just
mm-hmm.
Lowe's and Home Depot in your portfolio.
Right.
But they wouldn't tell us we're crazy for
to start a hardware store.
But I can almost guarantee you our hardware store would flop because mm-hmm. they're already...
Because Home Depot and Lowe's would kill us.
Right, they're cheap, they'd be cheaper, they'd have more product, they already have a presence.
Yeah.
Yeah.
So it just speaks to diversification a little mm-hmm. bit. Now, this isn't financial advice, but it's an interesting thought, exercise.
It's a very interesting thought.
And I'd never thought of it before until he had brought it up.
Yeah,
and he's absolutely right.
Yeah, and one more thing about Warren, a lot of people like to quote the idea that Warren, when he passes, has mm-hmm. told his family to put his money in index funds.
Right.
And Warren is always saying, the average person should put their money in index funds.
Right.
Right. So everyone's like, oh, he's an advocate for index funds. I don't actually think that's true. I kind of think you need to do the look what he does as opposed to
what he says.
Because he says all the index funds, but he himself admits that he at one point put 40% of his portfolio into one position.
Right.
So he's obviously an actual believer in concentration.
Yeah.
But he
if
also
you
doesn't
understand the business,
and if the business has a durable competitive advantage.
Yeah.
But he doesn't want to mislead people and then have them blow up their account.
Right. So, I think that's the bottom line.
Yeah.
So there was, and I think there was a couple of famous investors actually at this
mm-hmm.
meeting. One was Bill Ackman,
which we mentioned
previously, and actually, if he's maybe a little less famous, but
a lot less famous.
Chris Davis was actually there, son of or grandson of Shelby Davis, and Shelby Davis is probably one of the greatest investors you've never heard of. And Shelby
Davis went out of his way to not be known. He said he wanted to be the greatest anonymous investor on Wall Street. Yeah,
and I think he's the one that asked the question. He asked Chris. Chris is the one who asked the question about economic value. He said, how do you come up with, I think this was him, how do you come up with the economic value of a company? I'm pretty sure that was him. And so basically they said that they discussed a lot of that in their 1992 annual report.
Right.
I've gone through the annual report in 1992. I got through the first 10, 15 pages of it, and I haven't come across it yet. So if you're interested in that, then look into it. But you had drawn something from that too.
So, well, he mentioned a few things that were helpful. So he said what they look for are cash flows.
Mm-hmm.
That is the most important thing.
Mm-hmm.
He said, so the question was kind of based around different accounting practices, and with such discrepancies between GAAP numbers and other accounting metrics, how do they value it when the numbers can be so different?
Right.
And he just kind of, he didn't touch too much on that, but he started going off on a tangent, Buffett did, about cash flows.
Right.
And he was saying, we don't really care what if the business has no cash flows, we don't want it.
Right.
And then he went on to say, we need to be able to project the cash flows out 20 years.
Yeah.
So that caught my
huge.
attention, right? Because he gave a timeline as to how far they project into the future.
Yeah.
And I feel nervous projecting like 5 years into the future.
Yes.
But they said we need to be able to project the cash flows for the next 20 years.
Yeah. And based on those, and this is just from other readings that I've done on Buffett, and this was in the 1992 report, he said they aim to generate a 15% increase in intrinsic value every year.
And that was a huge insight.
For sure.
To know what they're looking like, what do we demand from our investments?
Yeah. And so if they'll only buy businesses that will actually, they think that can do that, essentially. Because those earnings have to keep that pace in order for them to generate that kind of return they're looking for.
Yeah.
At least at that time in 1992.
Yeah. And because he was talking about how to value a company, he also talked about growth rates a little bit. And one thing he said is that we actually don't need a huge growth rate. What we need is a cash machine.
Yeah.
He didn't say that exactly, but he said they've bought
businesses,
companies, and See's Candy is one, because you looked into it, that don't actually grow.
Barely
They're
at all.
not growing, right? But they are just throwing.
Spew off cash that they can invest.
Right. He said if it has a huge growth rate, but they're not generating cash, he's like,
or they're using up cash. That's often what happens.
That's what he said. He said that is not a good business. He said I don't care how great the growth rate is if they're using up all their cash. But he said if they're not growing at all, but they're just generating cash like crazy, he said that is the business that they want if they can project those cash flows over the next 20 years.
Yep, and they're going to be stable and they can buy it at a reasonable price.
Yeah, so that was a great insight. That was a great little piece of information that you can take.
For sure.
away
So
as an
what I took away from that is don't be afraid to buy a business that's not growing.
Right.
As long as it's throwing off a lot of either free cash flow or dividends or whatnot.
Which is totally contrary to what Wall Street
was
does.
looking for.
Right, and also like what you hear a lot of investors, and everyone's about the growth rate.
Yeah.
Growth rate. They have a 30% growth rate for the next 5 years, a 25% growth. And here Buffett's saying, oh, we'll buy a company that's, growing at 1 to 2%. And then he says, or maybe not growing at all.
Right.
As long as they're generating cash.
Yes, exactly. So I thought that was a very good point to take away for me.
And in this same question, one thing he said is that you don't need to be a mathematician. What you need to do is understand the business.
Yeah.
And I have come to learn from reading a lot by Buffett, reading a lot by Munger, and a lot of the Davis Dynasty. Reading all these books has actually shown me that the numbers part of it is not nearly important as the business. Yeah, and the emotional fortitude of the investor.
100%. No, I think you're absolutely right about that.
Yeah.
Yeah. The math is basic. The math is basic. Like you don't need to understand complex math, but you do need to understand where the business is.
Yeah.
And that's where a lot of the businesses that come along for them, they say they go in the too hard pile.
Yeah, exactly.
They don't bother.
They don't bother. Yeah. So lastly, and this was kind of at the very end of the entire 1994 meeting, he talked about the capital allocation abilities of the CEO.
Yeah.
And he said, very, very, very few CEOs have the ability to properly allocate cash.
Right. And to generate a good return.
And to
basically, is what he was saying.
Right.
And I think he used the analogy of a piano player who's made it to Carnegie Hall and then all of a sudden is given a violin.
Right. And the reason he said that is because the backstory to that is that the education doesn't train them. So he said you have these CEOs.
Well, and the skill set to get to the C-suite like that, you have to have a certain skill set.
Yeah.
And that may not be capital allocation.
Right.
Right. So,
that's true.
Yeah. So you have a certain. You might be.
You have the right education.
Energetic. You have the right education. You're energetic. You're charismatic.
Know the right people.
You know the right people. So all these things, and none of that has to translate necessarily into capital allocation.
Yeah. So, and he said if you find a CEO who knows how to execute capital allocation and get a great return on it, that is an excellent CEO.
Yeah.
And I think he does say I think in 1994 he says that the CEOs are not properly educated to allocate cash properly or allocate capital properly. And he can't figure out why, because that is like their main job.
Yeah.
He's like
allocate capital.
He's like a CEO's like number one job is capital allocation. And yet that is not something they teach in the universities and it baffles him.
Yeah, he was faulting more the education system in that regard.
Yeah. So Buffett says the CEO he has 1 to 3 main functions, and within those 1 to 3, it's proper capital allocation.
Yeah.
And he said what a lot of these guys do because they have not been properly trained, they don't have that skill set. They actually give it to someone else
Yeah.
And he said that's a red flag to us.
Sure.
When the CEO is giving capital allocation duties to another person on the team,
right,
they watch that. Yeah. Because he said usually that other person will fail.
Right, that makes sense.
Right,
like you don't delegate the most important part of your job, right, or one of them.
Right. I mean, they said
that's why you're there.
They said that is one of three, if not one.
Right.
The only main function of a CEO is to properly allocate cash. So that was great. That was a great
point. So if you can find a business where the CEO is also a great capital allocator, and recently listening to an interview with Manesh Pabrai, he was talking about Pony Ma being an incredible capital allocator for Tencent and Jeff Bezos.
And in Manesh Pabrai's mind, Pony Ma and Jeff Bezos, he said, were the best capital allocators out there.
Yeah. So
that's interesting.
I just thought it was a good point. Anyway, so I think that summarizes the annual meeting. I mean, we encourage everyone to go and watch the annual meeting for yourself. You can find it on YouTube.
So we'll wrap it up there. And if you like this video or you found anything useful, like and subscribe. And again, go and watch it for yourself. It's a million times better to hear it from them than from us. And we will be back next week.